Strong numbers, weak lives. The invisible tax behind a booming economy. Stop scrolling for 10 seconds and answer this honestly. If the economy is winning, why do so many Americans feel like they're losing ground? That question is the real story hiding behind the victory lap headlines. Strong GDP, record markets, cheaper gas, big tariff revenue. On TV, it sounds like a clean triumph. In real life, it often feels like a smaller life. Here's the thesis, plain and sharp. A strong economy on paper can still be a weak life in practice when the gains flow upward and the costs stay glued to the kitchen table. You've seen the numbers. GDP prints hot, stocks hit records, inflation cools, gas drops. Officials point at tariffs and say, "Look, money coming in." The message is clear. The model works, the critics were wrong, and the country is back on track. But households don't live inside GDP, they live inside monthly bills. And that's where the disconnect begins. Picture a typical paycheck household. Not rich, not broke, just trying to run a normal life. The deposit hits on Friday, and by Monday, half of it is already spoken for. Rent or a mortgage takes the first cut. Then health insurance or a medical bill, sometimes both. Then a car payment that used to feel manageable until interest rates turned manageable into barely. Then groceries, which might not be skyrocketing this month but still cost far more than they did a few years ago. Then utilities, then childcare, then a credit card minimum that used to be a nuisance and now feels like a leash. That household hears, "The economy is booming," and asks a simpler question, "Where is my boom?" This is the part that gets lost when headlines become propaganda. Growth is a national measure. Strain is personal. And personal strain is what elections, trust, and social stability are made of. So let's walk through the celebrated story and then expose the missing bridge between the numbers and the lives. Start with GDP. A 4.3% print sounds like momentum. But GDP is not a moral verdict on whether families are thriving. It's an accounting summary of economic activity. It can rise for reasons that don't improve the median household. One of the least discussed reasons is simple math. If imports fall, GDP can rise because imports are subtracted in the GDP equation. In other words, you can get a growth pop from changes in trade flows that don't feel like prosperity on Main Street. You can grow on paper without growing in paychecks. That's not a conspiracy. That's how the measurement works. And it matters because the public is being asked to treat GDP as proof of well-being. Now add the stock market. When commentators point to a record year on Wall Street, they're pointing to the most politically powerful symbol in American economics. The scoreboard is up, therefore America is winning. But the stock market is a scoreboard for capital. It measures profits, expectations, and liquidity. It rewards companies that can raise prices, automate labor, consolidate power, and protect margins. It does not measure whether a family can afford a starter home, whether childcare is crushing them, whether their insurance premium jumped again, or whether their credit card interest quietly doubled the cost of last year's normal. A rising market is real. It's also uneven. Many households don't own enough of the upside to feel it. So the country can celebrate record highs while millions of people experience nothing but a higher cost of living and a thinner future. Numbers up, lives down. Then there's gas. This is the most effective talking point because it's visible. People feel it immediately. If you paid less at the pump this week, you noticed it. But gas is a line item. Housing is a life sentence. The expenses that define whether Americans feel stronger are the ones that can't be avoided. Rent, healthcare, insurance, debt service. These are not optional. They are not luxuries. They are the infrastructure of daily survival. When those costs stay high, people feel weaker no matter how strong GDP looks. And this is where the media victory lap becomes dangerous. It trains the public to ignore what actually determines quality of life. It elevates national indicators that flatter power and downplays household indicators that expose pain. The most revealing example is tariffs. In the story you shared, tariffs are framed like a win. Big revenue, proof of toughness, proof the skeptics were wrong. It's presented as if America found free money. But tariffs are not free money. They are a tax mechanism. Here's the cleanest way to say what television rarely says. Tariff revenue is the headline, but higher shelf prices are the invoice. Tariffs are collected at the border from importers. What happens next depends on the market. Sometimes firms absorb some cost. Sometimes foreign producers cut prices. Sometimes retailers eat margin. Often consumers pay more. Even when the consumer doesn't pay more on the exact item, the economy pays through friction, disrupted supply chains, delayed investment, reduced variety, and uncertainty that forces businesses to operate defensively. This doesn't mean tariffs never work for any purpose. It means you can't treat tariff revenue as pure gain without asking who paid and where the costs landed. That missing question is everything. If the government wins revenue, what did households and businesses lose to create that win? That's the invisible tax. And it's a perfect symbol of why the economy can look strong while people feel weaker. Because the system has grown better at collecting wins on paper while distributing stress in real life. Now, zoom out. The core problem isn't whether the numbers are fake. The core problem is that the numbers don't measure the pain people live with. Inflation can cool and still leave a scar. Because most families don't experience inflation as a monthly statistic. They experience it as a permanent shift in the level of life. If prices jump over several years and wages begin to outpace inflation slightly, families don't feel rich. They feel like they stopped bleeding but haven't healed. They're still paying higher rent, higher insurance, higher grocery bills, and higher interest on debt that piled up when life got expensive. A small real wage gain after a big price shock doesn't restore the old world. It just slows the decline. This is why people can hear real wages are rising and still feel resentful. Because they're not comparing life to last month. They're comparing life to the life they were promised. You can feel that in the way people talk. It's not just, things are hard. It's, I'm working harder and getting less. That's the emotional definition of feeling weaker. Now bring in housing, because housing is where this entire story becomes undeniable. A middle-class economy depends on asset access. And in America, the primary wealth escalator for ordinary families has long been home ownership, a monthly payment that becomes equity, a stake in stability, a buffer against chaos. When home ownership becomes delayed, blocked, or pushed into the future, people don't just feel poorer, they feel locked out of the American bargain. So when the strong economy story leans on markets and GDP while housing remains punishing, it becomes a story for investors, not for citizens. The result is a society that can post strong fundamentals while the average household loses its wealth-building path. This is why the phrase first-time buyer matters more than the phrase record close. The first-time buyer tells you whether the future is being built. The record close tells you whether the present is being monetized. And that leads to the next underreported factor, debt stress. High-interest debt is quiet. It doesn't announce itself on cable news, but it is one of the most powerful forces making Americans feel weaker. A family can have rising wages and still be crushed by revolving interest. A household can have good income and still be trapped by a credit card balance that grows faster than they can pay it down. When rates are high, debt becomes a second rent payment. This is why consumer confidence can fall even when the macro picture looks bright. Confidence is not just about the present, it's about whether people believe the future is opening or closing. If the future is closing, if home ownership is delayed, if healthcare remains a threat, if debt service consumes the margin, people retreat. They postpone kids, they skip moves, They stop investing in themselves. They live smaller. And that retreat has consequences beyond economics. Because the real output of an economy is not just goods and services, it's legitimacy, trust, social cohesion. History doesn't punish countries for bad quarters, it punishes them for broken trust. When leaders insist, everything is fine, while households feel constant pressure, people stop believing the scoreboard. And when citizens stop believing the scoreboard, they stop believing the game. That's the political consequence the segment never touches. The cost of the victory lap narrative isn't just misinformation, it's alienation. The public learns to hear good news as manipulation. Every strong number becomes suspicious. Every optimistic forecast becomes propaganda. And in that vacuum, politics becomes raw, more cynical, more extreme. Because the moderate language of technocrats no longer matches lived reality. That's how you get volatility even during expansion. That's how you get anger in good times. That's how you get a country where the phrase, strong economy, triggers resentment instead of reassurance. So here's what to watch for the next time someone sells you a booming economy. When you hear GDP, ask what drove it. Was it household purchasing power? Or was it trade math and government spending? When you hear record markets, ask who owns the upside. Is this prosperity broad or concentrated? When you hear inflation is down, ask whether affordability is back. Falling inflation does not mean life became affordable again. It only means prices are rising more slowly. When you hear tariff revenue, ask who paid the invoice. Revenue is visible. The cost is often hidden, distributed through price shifts, margins, and uncertainty. And when you hear promises about next year, ask what structural constraint actually changes between now and then. If nothing structural changes, the story repeats. Strong numbers, weak lives, louder messaging, deeper distrust. The point is not to deny that some metrics are improving. The point is to tell the truth about what those metrics do and do not mean for the daily American experience. Because the American crisis right now isn't a lack of growth, it's a lack of translation. We've built an economy that can generate impressive top-line indicators without generating shared security. We've built a system where corporate strength can grow alongside household fragility. We've built a politics where leaders can point to charts while families point to bills. If you want to understand the country, stop asking whether the economy is strong. Ask who the strength is for, and who pays for it. That is the only question that connects power to everyday life. And it's why the central reality still stands. A strong economy on paper can still be a weak life in practice when the gains are concentrated and the costs are sticky. Now I want to hear from you, because your answer tells the real story no headline can capture. What's the biggest gap you've felt between strong economy news and your own daily budget? Housing, healthcare, groceries, debt, childcare, or something else? No noise, no spin, just clear, fact-based analysis that connects power to everyday consequences.